We're starting off with a story that's been making waves in the financial sector, the age-old debate between investing in individual stocks versus exchange-traded funds, or ETFs. A recent article caught our attention, which asks the question, is a financial sector ETF a better buy than picking the stocks yourself? The article highlights the benefits of owning an ETF, such as the State Street Financial Select Sector (SPDR) ETF, which tracks the performance of the financial sector of the S&P 500. One of the main advantages of ETFs is that they offer diversification and reduced risk, as they hold a basket of stocks rather than just one. This can be particularly appealing to risk-averse investors who want to tap into the financial sector without taking on too much exposure. For example, the article notes that the ETF holds top holdings such as JP Morgan Chase and Berkshire Hathaway, but at a fraction of the cost of buying individual shares of those companies. This can be a more accessible way for investors to gain exposure to these stocks, especially for those with limited budgets. However, the article also acknowledges that buying individual stocks can be a better option for investors who are comfortable with taking on more risk and have done their research on a particular company. These investors may be willing to ride out market fluctuations in pursuit of higher returns, and may even enjoy the process of studying a company's ins and outs to make informed investment decisions. Ultimately, the decision between investing in an ETF or individual stocks depends on your personal financial goals, risk tolerance, and investment strategy. As always, it's essential to do your own research and consider multiple perspectives before making any investment decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're continuing our conversation about the tech industry, specifically focusing on the semiconductor sector and the companies that are making waves in artificial intelligence. As we've been following the news, these companies have been experiencing significant growth, with AMD and Intel seeing substantial gains this year. However, Wall Street analysts have varying opinions on which stock is the best buy for the next year. According to their consensus, Nvidia has a projected 38% upside with a one-year price target of $303. AMD is expected to see a 27% gain with a price target of $613, while Intel's projected gain is 19% with a price target of $115. What's interesting is that despite Intel's significant growth this year, 32 out of 48 analysts covering the stock have indicated it as a hold. This could be due to concerns about the company's ability to revive its foundry business and find key clients. On the other hand, Nvidia, which has been a top pick since the AI arms race began in 2023, is seen as a more stable choice with a reasonable valuation. One of our contributors, Keith Drury, argues that Nvidia is the best buy among the three, citing its projected dominance over the next few years and its relatively low valuation compared to AMD and Intel. However, it's essential to consider multiple perspectives and do your own research before making any investment decisions. As we weigh the pros and cons of each company, it's clear that the semiconductor sector is rapidly evolving, with AI driving innovation and growth. As investors, it's crucial to stay informed and adapt to changing market conditions. Welcome back to the Riskwiser Zone. We're wrapping up today's show with a look at the current state of memory stocks and their relationship with the artificial intelligence trade. Recently, we've seen these stocks experience a bit of a downturn, with some investors taking profits and repositioning themselves in the market. Now it's essential to note that this shift isn't necessarily due to any fundamental changes in the companies themselves, but rather a response to the increasingly complicated macroeconomic backdrop. Rising interest rates, concerns about the credit market, and the potential for rate spikes are all contributing to a sense of uncertainty among investors. Despite these challenges, many experts believe that the fundamentals of memory stocks like Micron Technology, Western Digital, Seagate Technology Holdings, and SanDisk Corp remain strong. In fact, some analysts have even upgraded their outlooks on these companies, citing their growth prospects and balance sheet strength. One factor working in favor of these stocks is their relatively low valuations compared to other technology companies. For example, Micron trades at around 6.5 times earnings expected over the next 12 months, while SanDisk's multiple is approximately 7.3. This makes them among the more affordable options in the tech-heavy Nasdaq 100 index. Of course, it's also important to consider the potential risks and volatility associated with these stocks. As we've seen, even small changes in market sentiment can lead to significant price swings. However, for investors who are willing to take on that risk, there may be opportunities for long-term growth. Ultimately, the decision to invest in memory stocks or any other asset class should be based on your individual financial goals and risk tolerance. It's crucial to do your own research, consult with a financial advisor if needed, and approach the market with a clear understanding of the potential risks and rewards. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.